me for inviting me to present to the community. Very happy to be presenting today. So today's presentation is all about tax year end planning, making the most of the opportunities before the end of the tax year. Today is the 14th of March, so that means there's only 22 days left to go until the end of the tax year. Tax year ends on the 5th of April, 2023. So in today's presentation, I'm going to go through some of the things that you need to be aware of, especially in terms of the current allowances are going to be cut. A lot of things will be going up. So this will mean that you will end up paying more tax. So for example, income tax is changing, capital gains tax is getting reduced, dividend allowances are changing, they're getting reduced as well. So there's a window of opportunity to make the most of your tax planning and make sure that you hold on to as much of this money as possible. So what I'll do now is I'll share the screen with you. Hopefully you can see that.
Yeah, we can see it. It's not on slideshow mode, it's on.
I'll just put it into slideshow mode now. Here we go.
Yeah, perfect.
So like I said, it's crunch time. Time is running out in terms of the tax year. Every year, tax year is on the 5th of April. Whatever allowances you don't use will, unfortunately, a lot of them will end up getting wasted. So make sure you don't waste or not maximize your allowances, because you'd be missing out from that point of view. So my role is really to understand your situation. So yeah, my role is as an advisor is really to understand your situation, either personal or business, what your aspirations are, what your goals are, what's actually important to you in terms of the future circumstances, building money up for your family, protecting money for your family, or being able to pass it on to your children later on in the future in a tax efficient way. So to do this, we need to understand what assets you have at the moment, how we expect those assets to increase. Are you likely to have other assets that we need to take into account? Now, financial planning can be complex because there's a number of changes that are coming in all the time. There's a lot of things that's happening in the world which may have an impact. Things like global interest rates, global inflation concerns, of course, Russia-Ukraine situation, energy bills, fuel bills going up through the roof, shortages caused by Russia-Ukraine, because a lot of things do come from that part of the world, and all of that has an impact on inflation. So these are some of the things that are taking place in the world at the moment. And these events could have an impact on your money, your wealth, and your financial well-being. So it's very important to review what you've done previously, make sure that your planning is current and up to date. And that's what we help our clients to do. So I bring this expertise. I've been helping clients since 2005. So over 16, 17 years of industry experience, and being able to help clients make the most of their situation and take it full advantage of any tax reliefs and allowances available. So key point here is don't let your tax allowances go to waste. You have to try and use up your allowances each and every single year wherever possible. Any allowances you don't use will unfortunately be lost, they'll be wasted, and you won't get those back again. Now, I said there's only 22 days to go until the end of the tax year. That's not a long time. So what I would recommend would be that you look at this very, very urgently, because there's only a short time to go. Whatever right actions you take now is going to be beneficial for you in terms of your financial goals and your well-being. More tax you save means there's going to be more money in your pockets. You're going to be better off financially. And the key to all of this is making sure that you're making the right use of savings, investments, pensions, whatever it is. And we combine that with the most tax efficient strategies that will allow you to maximize your money. Now, I understand, of course, everyone is different. We all have different financial goals. We all have different understanding, situation, background. Everything is different. But the advice we provide covers for every single different type of individual situation there is. So, and having a meeting means that you can take full advantage of the allowances and reliefs, and they have a use by date of the 5th of April. And it's also important to do proper financial planning when there's a lot of great financial uncertainty in the world. There's a lot of uncertainty. It certainly pays to make things as efficient as possible. Take advice, don't bury your head in the sand. Doing nothing is usually not a good option, because it's not improving your financial situation. So everything we do, everything we talk about is really about improving your financial situation. So here we'll have a look at which financial goals are more important to you. Of course, everyone is different. It'll depend on what stage you're at in your life. So as a starting point, you might be thinking about, you want to start building a foundation. You're looking at start saving, start investing in your money. You want to make your money work harder for you. Priorities could be thinking about buying your first home, planning for a family. All of these things, the earlier you plan them, the better it's going to be. Then you need to think about secure your and your family's financial future. So this is making the most of your investments. If you've got children, trying to give them a good head start in life with good financial planning, and making sure that you're building up sufficient funds to be able to have a comfortable retirement. Now, if you bear in mind that the cost of living is going up, so whatever your pension pot is at the moment, we have to make sure that it's growing. Inflation is currently 10%. So if you're getting less from your savings, the interest you're getting from other accounts, that's going to have an impact on the final value of your money. Because if inflation is 10% and the rate of interest you're getting is only 3 or 4% at the bank, then of course you are losing out. Your money is losing value. It's going backwards. We have to think about retiring in style. So making sure that you've got the money to be able to enjoy the retirement that you've always wanted to have. Now, retirement can mean lots of things to different people. Some people may want to do more charity work for the Samaj. People may want to go on more holidays because they got more time. People may want to spend more time with their children, grandchildren, all of these things. Whatever it is, it's about making sure that you've got enough to enjoy a healthy retirement. And then after this, we've managed to accumulate some good assets. Then we have to start thinking about passing assets onto your family. The more assets we can keep within your family, the more it's going to help your family members. So we talk about things like inheritance tax. Again, the more you plan, the more you save, the better it's going to be for you, your family in the long run. Not just your immediate family. You have to think further ahead. So this could be your children, your grandchildren, possibly even your great-grandchildren if you're lucky enough to have grandchildren or great-grandchildren. So these are all the things that we need to start thinking about from now. It's never too early to start planning these things. Life is unpredictable. Life is full of uncertainty. And we know whatever planning you do, it's going to be beneficial in the future. If you don't do anything, then it's potentially going to be a problem for someone which you don't want to leave. So now we look at why you should invest in an ISA. ISAs are great vehicles. They've been around for a long time. Different names they used to have. PEPs, some of you may remember PEPs, TOISAs, and now they're ISAs. So they've been different versions, but effectively, they are flexible, tax-efficient savings, and they allow you to meet your short and long-term goals. So there's different types of ISAs. You can have a cash ISA, you can have a investment ISA. The great thing is with ISAs, everything you have in an ISA is free from income tax, capital gains tax, and dividend tax. So you can see that ISAs are very tax beneficial. They're a simple and great way to start investing in stocks and shares. and everybody has a £20,000 ISA allowance every single year. And you should really try and utilize as much of it as you can, because when we get to the 6th of April, this year's the allowances we have at the moment will then disappear and no longer be available to you. So the idea is, if you can put as much money into an ISA as possible, you keep doing it over a number of years, you're building up your ISA pot. You're also protecting more money from tax. And of course, if you can protect more money from tax, it means it's going to be more money in your pocket in the future. We have to make sure that anything we do stays ahead of inflation. Currently, the base rate is 4%. So if you put your money in the bank account, maybe you get maybe about 3%, 3.5%. But currently, interest rates are well below the rate of inflation. So investing in a cash ISA means your money loses value in real terms. Think of it this way. You have £100,000 in cash. Inflation is 10%, and interest rate might be 3%. So the fact that inflation is 10%, that means although you got £100,000 in your bank account, that £100,000 in real terms, in purchasing terms, will be £90,000. Just by leaving your money in the bank account, you're destroying value. Clearly, that doesn't make any sense. So if you're going to, obviously, holding money in cash makes sense if you're going to hold it for the short term. You're thinking you're going to need it in 6 months or 12 or 18 months, then certainly holding it in cash makes sense. But if you're thinking some of this money, we don't need it for 5 years, then really investing in a stocks and shares ISA over a long period of time is a great way of getting better returns on your money. Over time, growth will beat inflation. Of course, at the moment, we've got very high inflation of 10%, but we don't expect that inflation to last forever. Maybe end of this year, early next year, because of the actions being taken by the central banks, we expect inflation to, of course, start coming down and becoming a bit more manageable. Investing in an ISA, so adding a little bit each year goes a long way. So every year you have a £20,000 allowance. Every year, whatever's possible, you should always put some money into your ISA or your pension. You should be saving this money because it will be beneficial for you in the future. The power of compounding. So we're talking about investing a little bit every year. The power of compounding is when the return compounds. So for example, if you invest the money over a long period of time, you combine it with tax efficient investing strategies, then that's going to make a big difference in the long run. So the longer you leave the money to compound, because you get return growth on top of growth, then the compounding becomes more powerful. And the figures show how investing £5,000 annually into a stocks and shares ISA, the value of your money grows by reinvesting returns back into your ISA. And the key thing here is you won't pay tax on interest or profit. So again, more money you put into ISA, more money you're protecting from tax, essentially more money in your pocket. So here it shows you what happens if you keep investing £5,000 per year. The green line is the total return. The red line is the capital invested. So 5,000 in 5 years, you would have invested 25,000. That would be worth 26,000. Over 10 years, slightly longer term, you've put in £50,000, and by then it could be worth £57,098. And in 20 years, you've put in £100,000, and that £20,000 could be worth £129,480. So there's some assumptions here of growth rates after charges of 2.4%. So what we're seeing is the longer you invest, the longer you compound, the more compounding that takes place, the better the result will be further down the line in the future. So we should also think about investing into an ISA for children. They're called junior ISAs. They can be cash ISA, like adult ones, and you can also have an investment ISA for children. Now, bearing in mind that this money, cash ISAs can't be accessed till the age of 16, and investment ISA can't be accessed till the age of 18. So what it allows you to do is it allows you to start saving money or investing money in a tax efficient way for children for the future. So again, like the other ISAs, the money is free from income tax, capital gains tax on any gains. And a JISA, a junior ISA, is a great way to give money to your children. It helps to reduce your inheritance tax liability. So it helps you by removing money from your estate, and it helps to give the children a great head start in life later on when they need it, for when they want to buy their first property or getting married, whatever it is. There's money that's gone into an ISA. So definitely makes sense to put money into an ISA. Think about the compounding that I've mentioned so far, because the money can't be accessed until the age of 16. So the money's going to sit there. If you've got young children, young grandchildren, then certainly worth considering. The money stays there, stops them spending it. And of course, the money will continue to grow. It's very important that the money does grow, because if you leave your money in a bank account, inflation will wipe out anything you're making. So where inflation is higher than the interest rate, it means that the value of the money is getting eroded. The time value of money is going to be worth less in the future. So we know what £100 is worth now. We know what £100 was worth 10 years ago. And we know that the £100 10 years ago was a lot more valuable than £100 today. So that's an example of inflation eroding the purchasing power of your money. So we should also consider ISA allowances for 22-23, the current tax year allowances. So currently it's £20,000 per person. For a couple, they can put in £20,000 each, so £40,000. And for children, the limit is £9,000, which can go into a junior ISA. And the key thing is, with these ISA allowances, they work on a use it or lose it basis. You can't carry it on. You can't roll it into another year. So if you haven't already done an ISA or a junior ISA, think about doing one certainly before 5th of April. So then we'll introduce now the personal savings allowances. So this is really about being smart with your cash. Personal savings allowance means no tax on some of the interest earned on savings in cash savings accounts. So this allows you to earn a little bit of interest, depending on whether you're a basic rate taxpayer or a higher rate taxpayer, and not have to pay any interest in it. So with interest rates rising, it's more likely your savings will be subject to tax, especially if you're a high rate taxpayer. So before, when the interest rates were very low, you had to have a lot of money in bank accounts before you would exceed your personal savings allowance. But now, obviously, with the interest rates going up and you're making more interest on your money in bank accounts than you had done previously, then it means that you will soon start exceeding your personal savings allowances. So, of course, like I said at the beginning, it's very important to have emergency funds in cash. If you think you always need emergency fund, if something goes wrong, you need access to this money quickly. So therefore, you need somewhere where you can keep this cash money. If you can put it in a bank account, you can maximize your personal savings allowance. That means that your cash ISA, rather than having money in a cash ISA, which could be potentially wasting the allowance, you could invest the money for longer term goals into a stocks and shares ISA, which will give you a lot more potential, a lot more opportunity for longer term growth. So here's how much you could hold in an easy access account before paying tax on interest. If you're a basic rate taxpayer, you could hold £40,000. And if you're a high rate taxpayer, by the time you have £20,000, you would then be exceeding your personal savings allowance. So what is the personal savings allowances for the current tax year? For basic rate taxpayers, you can get up to £1,000 a year interest-free interest. You can get £1,000 a year interest, which is tax-free. If you're a high rate taxpayer, i.e. you pay 40%, then it's £500 a year is your allowance. And if you're an additional rate taxpayer, i.e. 45% taxpayer, then you have no personal savings allowance. Now, we have to watch out for the 60% tax trap. There's lots of different traps we have to be aware of. if you're not careful or you're not aware of these, it's going to end up costing you more in terms of tax. The whole thing is to make sure that you're as tax efficient as possible. So if you earn less than £100,000 per year, the first 12,570 is what's known as your personal allowance. So within your personal allowance, it's going to be free free of income tax. However, earnings between 100,000 and 125,140 will reduce your personal allowance by £1 for every £2. So let's say, for example, your income is 125,140. That means you're going to have lost your whole personal allowance of 12,570. Anything between this 100,000 and 125,140, because of the loss of the personal allowance, this means that you're going to be paying tax at 60%. So it's a very high, expensive, prohibitive rate. At the end of the day, you don't want to end up paying 60% tax on this proportion of the earnings. Ideally, you'd like your earnings to be below £100,000 so you don't have this issue. So if earnings above 100,000, you could be taxed at a rate of 60%. And here's how it works. So let's say, for example, you're a 40% taxpayer. Assume your income is 100,000 and you get a bonus of £10,000. So on the bonus of £10,000, you're going to pay £4,000 income tax. You'll also pay an additional amount because you're losing £5,000 of your allowance. So if you pay another 40% on the £5,000 allowance, that's another £2,000. So 60% total £6,000. I'm sure you'll agree that is a lot of money to pay in tax. So what you should do is you should avoid this trap by paying. If you've got earnings over 100,000, you should increase your pension contributions. This will allow you to get your full personal allowance back. You'll get 40% higher tax relief on contributions. So that's great. And how it works with pensions is 20% is claimed at source, is directly available, and then the other 20% is claimed via self-assessment. So just be careful of this trap. Now, one thing to make you aware of, right now in the current tax year, if your earnings are over £150,000, you will pay tax at a rate of 45%. You'll pay the top rate of income tax. However, from the 6th of April this year, in 22 days' time, if your earnings are over £125,000, you will end up paying 45% income tax. So they've dropped the band. Therefore, it means more people will end up paying tax on this. Now, you might be somewhere in between these figures. You might be on 97, 98, even 90,000. What you've got to be aware, although you might not necessarily have a problem right now, you could have a problem in a year or 2 years' time, because you might get a promotion, you might get a pay rise, your pay might go up just in line with inflation. All of these things will end up pushing you over the £100,000. So you've got to be careful. So what they've announced in the previous budgets is that from 23-24 tax year, more people will be affected as earnings rise. But of course, income tax thresholds could be frozen or reduced. Obviously, we don't know what the budget will bring tomorrow. I'm sure it'll bring a few surprises, maybe some good ones, maybe some not so good surprises. But we have to always plan on what the current rules are. And then as things change, we would advise you on what the most efficient way of planning is. And the key thing is to make sure really that you're making the full use of your tax-free allowances. At the end of the day, I don't want you to end up paying more tax than you need to. It's absolutely pointless paying more tax. We already pay a lot of tax in the UK. The UK is one of the highest tax countries in the world. This is about making sure you're using up your allowances smartly and making full use. Pensions. So here we're looking at what you need, why you need a pension. It's certainly important for a happy retirement. So pensions is one of the best ways to save for retirement. And the great news with pensions is they're very, very tax efficient. So this tax year, you can pay the maximum up to of £40,000 or 100% of your salary, whichever is lower. So let's say your income is £40,000, you could put in £40,000. If your income is higher, then you can take advantage of the carry forward allowance, which allows you to make use of pension, any unused pension allowances from the 3 previous years. So how it works with pensions, if you're a basic rate taxpayer, you pay 20% income tax. Then to get £100 in your pension pot, you pay £80. You get tax relief from the government of £20. So to get 100, it's only costing you £80. If you're a 40% taxpayer, to get £100 into your pension pot, you'll pay £60, and the rest, the balance £40, you get back from tax relief. So you can see it's very, very efficient way of building up your money. Additional rate income taxpayer, so this is a 45% taxpayer. You pay £55, you get income tax relief from the government of 45, so that gives you £100. So what we always say is put what you can into your pension now. The earlier you start saving, the better it's going to be. The longer you save, the more compounding will take place. The longer you allow compounding, the more powerful it will be. And always top up as much as you can before tax year end, 5th of April. So it's never too late to start saving. Just to give you an idea, if you plan to retire when you're 67 and you make a gross contribution towards your pension, i.e. only £200 a month, there's a massive difference of doing it at the age of 20. Your pension pot could be worth £349,000. If you delay to 30, just 10 years, then obviously your estimated pension fund could be reduced significantly to 215,000. And if you start at 40 and you're only putting in £200 a month, that's only going to give you a pension pot of £123,000. So you either need to start earlier or you need to increase the contribution. Sometimes it's not possible to start earlier. Sometimes it's not possible to increase the contribution, but key thing is start as early as possible and put in as much as you can. It's never too late to start saving. How much do you need to save for a comfortable retirement? So what we'll have a look at is the level of income required, the value of your pension pot to achieve your goal. And obviously this assumes you're entitled to full state pension. So that's currently £9,339. Now, we don't know what's going to happen in future budgets, whether the state pension amounts will change. There has been talk about things like the triple lock changing. So again, it just makes sense to make your own private provision just in case state pension is not available or it's reduced amount in the future. So here it shows you 3 different scenarios. If you put in the minimum, it tells you what you could do. There's a moderate one which allows you a bit more, and there's a comfortable one allows you to have extra holidays, that sort of thing. So the more you put into your pension, the longer you leave it, the better it's going to be in the future. So we said that you get the key reasons why you would invest in a pension. You get income tax relief on 100% of your earnings up to a maximum of £40,000. Of course, if you've got higher income and you've got unused allowances, you can put more money into your pension. So how that works is you have to use up the current tax year first, which is 22-23. So providing you've got earnings, you put in £40,000. Then you go back to 19-20 tax year and you use that up. Then you go to 2021 and then 21-22. So if you have earnings and you have allowances, you should maximize for this year's allowance and then go back to 19-20, because once we get to 6th of April, that 19-20 allowance will drop off. If you've got a company where you're employed by your own limited company, then the limited company can also make pension contributions and save corporation tax. So it's a very, very efficient way of saving tax, building up money for your future. And the current lifetime allowance is currently frozen at 1,073,100, which they've announced in previous budgets will be frozen until April 2028. The recent news says that they might look to increase this lifetime allowance, but really, it doesn't really benefit a lot of people, because how many people are going to have a pension pot more than 1,073,100? Not that many people. It's a very small proportion of the population. that will have pension pots that size. So yes, they might change it, but it's got limited benefit to majority of people. Here we're moving on to inheritance tax planning. So it's all about protecting your family wealth. So inheritance tax is taxed at 40%. It's a very high rate. It can give families a shock, especially if it's not been planned or something sudden, unfortunate happens, then there could be a big tax bill. So what we need to do is we need to make sure that we're taking full advantage, maximizing the relevant tax reliefs and allowances available. The minimum tax-free threshold, so every individual has a nil rate band, which is £325,000. Above your nil rate band, it's subject to tax at a rate of 40%. So in this example, is a single person, they've got a total estate worth 1.5 million. You've got an allowance of 325, and you've got 1,175,000, i.e. anything above that limit to be subject to 40% tax. So here it's about making the most of your tax-free gifting allowances. So there's various allowances that you can use. One of them is the gifting allowance, and that's a great way of reducing some of your inheritance tax liabilities. It allows you to make cash gifts to loved ones, to your family, and it's a great way to allow you to reduce your estate value. The more we can reduce your estate value, the less the inheritance tax will be. So more money for the family. You can invest in a junior ISA, or you can do a pension for your children or grandchildren. Again, that's another effective way of utilizing your gift allowance. Only parents or legal guardians are able to set one up. So here's how it works. The amount you can give away, this is per person. So for a husband and wife, so for an individual, they can give away £3,000. Husband and wife can give away £6,000 between them. And then if you haven't used the previous year's allowances, you can go back one previous year. So you could give away 6 plus 6, so £12,000. And the good thing by using up your gift allowances is that this money will immediately fall outside of your estate. So when we look at inheritance tax planning, we know that there's no tax to pay if you leave your estate to your spouse. Any transfers between husband and wife are exempt from inheritance tax. The first 325,000 for an individual is available. That's your nil rate band, and it's frozen until 2028 for every individual. So if you've got a couple, then that means £650,000 could be passed on without any inheritance tax. The tax-free threshold increases to 500,000 if your home is included in your estate, and it's left to your children, your grandchildren, or other lineal descendants, provided the estate is worth less than 2 million. So if you're a single person and you own a residence, then that means that your current allowance will be £500,000. And if you're a couple, then the current inheritance tax free threshold will be £1 million. Obviously, we have to take into account the value of your property, because that could reduce the amount of allowance available. Upon the death of the spouse, the allowance can be combined. So this gives you the £1 million, which can go to your loved ones tax-free. If you give away £3,000 every year, that's deducted from your estate. There's also a capital gains tax that you need to be aware of. You may fall into capital gains tax without realizing. So let's say, for example, you're given free shares in your company as a bonus, and the value of these shares are £5,000. Their value increases considerably, i.e. your company does really well, and they're now worth £25,000 in the future. This means that the gain that you've made, or the profit, if you sell them all at once, is £20,000. So the first £12,000, £12,300 is tax-free, but you still have to pay tax on the remainder of £7,700. And then if you're a high rate taxpayer, this is 20%. Therefore, the bill would be £1,540. So here's just showing you why you need to be careful about capital gains tax. And the way you can manage your capital gains tax liability is you can defer the sale of assets. So you can sell them in different tax years. You can sell some now in this tax year. You can sell some assets on the 6th of April in the new tax year. You can split your assets between husband and wife to help you utilize both people's allowances. And the other thing you can do is you can wait till your tax position changes from a high rate taxpayer to a basic rate taxpayer. So let's say, for example, your tax position is going to change from 40% to 20%. You might think it's better to delay the sale of an asset and reduce the amount of capital gains tax you can pay. So here we've said you can also put your shares into an ISA. The great thing is that they will be exempt from capital gains tax. Transferring your assets to your spouse means that you make use of maximum use of joint allowances. Of course, like I said at the beginning, things are changing. From 6th of April this year, the tax-free allowance will fall from 12,300 to £6,000. So the amount you can take before you have to pay tax is coming down to £6,000. And then again, it's going to reduce to £3,000 in 2024-2025 tax year. So the other thing you should do is make sure you're using losses and realizing gains. Can make a big difference in the amount of tax you have to pay. And you might have to move assets into different wrappers, pensions, ISAs, and to make sure you're not creating gains. Dividends. So here we're looking at if you receive dividends, they're going to be liable for dividend tax. Now there's a £2,000 dividend tax free, but then this is charged per your tax free. So if you're a basic rate taxpayer, you're going to pay 8.75%. If you're additional rate tax, if you're a high rate taxpayer, you'll pay 33.75%. And if you're additional tax rate payer, then you'll pay 39.35%. So in this example, you receive annual dividends, which is £5,000. Obviously, you've got an allowance of £2,000, so £3,000 is taxable. The amount you'll be paying, you'll be taxed this year at 32.5% is £975. And if you put your investments into an ISA, then there'd be no dividend tax that you would need to pay. So you can clearly see that holding it into an ISA is going to be more tax efficient. We know that dividend allowances are changing. So across last year or this year, the current level of dividend tax increased by 1.25% across the board in 2022-23. From 6th of April 2023, so in 22 days time, the dividend tax allowance will be cut from 2,000, will be cut to 1,000. So right now it's £2,000 and then it's going to reduce to £1,000. And then from 24-25 tax year, it's going to reduce down to £500. So again, if you're thinking about taking dividends, there's a bit of planning that you can do before the end of this tax year. And we would say that dividends should go into a tax efficient wrapper, e.g. ISA or pension. So here we look at your tax year-end checklist. So we spoke about lots of things, and these are some things that you can do, you should do. It's really about making sure that you're making full use of your allowances, you're building up your money, your savings, your investments, you're growing it by investing in the right way, and you're getting tax efficient wrappers to go with it. So make sure you utilize your allowance. It's £20,000. Spouses also have allowance of £20,000. You can put in up to £9,000 into a junior ISA for children or grandchildren. And again, it's very, very tax efficient. You should consider contributing into your pension, especially if you've got income and you've got allowances as well. If you're coming up to retirement and you need a large withdrawal, then talk to us about spreading the withdrawal over 2 or more years to reduce your tax liability, and take advantage of capital gains tax exemptions, 12,300. If you're a high rate taxpayer, you can bring your taxable income down by putting money into your pension. So this is if you earn currently more than £150,000 and you pay 45% tax. Obviously, from 6th of April this year, this will change to over £125,000, you'll end up paying 45% tax. So bring your income down. It helps you to hold on to your personal allowance, and it also helps you to hold on to your child benefit. Gifts of up to £3,000 per year. This will mean that it isn't included in the value of your estate, and so won't be liable for inheritance tax. If you own a business, consider taking dividend income instead of salary. The first £2,000 of dividend income is tax-free. And putting money into pre-tax profits into a pension, you can reduce your corporation tax, income tax, and also national insurance contributions. We can give you a helping hand. So we help you to make sure you're using the right efficient building blocks, and this will help you to create the financial future you want. We can help you make the most of your available tax reliefs and allowances before 5th of April. So this is what we do for a lot of clients. And it's about getting in touch before the 5th of April. Obviously, I would say don't leave it to the last minute, because we will get busy. We don't want to miss anything out. We don't want to turn anyone away, but we have to have sufficient time to get these things done. And I've also put my contact details on here. So if anyone wants to discuss anything in more detail, they just want a second view on some of these things, then by all means, feel free to get in touch with us at any point.
Okay, thank you, Dipesh Bhai. Was that the end of this last slide?
Yeah, that's the final slide. Yep, that's the final slide.
Okay, so you have your contact details here. So thank you very much for that. Very informative, as always. So I guess we can open it up for questions now. Is that okay?
Yeah, absolutely fine.
Okay, so I have one question from iPad. I don't know who that is, but they asked, please, can you explain the difference between various ISA accounts?
Yeah, so you've got a cash ISA, you've got investment ISA. Those are the two main types of ISA. Cash ISA doesn't have any growth attached to it. It's maybe where you might keep some of your liquid emergency funds. But don't forget, you also got the personal savings allowance. Investment ISAs can go up and down in value. They're more suitable for medium-term investments. If you're going to need the money for short-term, holding it in cash is fine. If you're not planning on using all of this money, then possibly investment ISA could be better.
Okay, hope that answered the question for that person. We have another one here, which was, will you be sharing your slides? So just to answer that question, this has been recorded and it will be posted on the SPA UK website. So the slides won't be shared, but the recording will be shared. Okay, so another question here, Dipesh Bhai. How does your investment compare year on year versus Vanguard Index Fund?
So every fund is slightly different. So there might be a time when certain funds will do well just purely because of the fund manager. Some of it will be to do with the market. Some will be to do with how what sort of investments they have selected. So different companies will do well at different times. It's very difficult for one fund or one fund manager to consistently outperform against all rivals, because things will happen in the markets. Investment manager strategies may change. So I would say, depending on the investments over a period of time, our investments compare well to what's out there on the market.
Okay, thank you. So another question here is, what is the personal savings allowance for an older person that receives a full state pension as their only income?
Same, £12,570.
Okay, same as everybody else.
Same as everybody else, correct.
Yeah. Question is, what is your fee structure for your services?
So what I would say is today's presentation is more really to give you an idea of the things that you can do, the things that you should do. If you want to know more about fee structure, I would say it's better to get in touch. We can then go through all of that in great detail with you. At the end of the day, everything would be discussed with you, so there wouldn't be any shocks or surprises.
Okay, good. Another question here. Is it better to pay off your mortgage or pay into your pension if you are over 50?
So that's a really good question. So it depends on what your income tax position is. It depends on how much your mortgage is. if you find that you're getting squeezed because your interest rates have suddenly, you've come off a fixed rate. Previously, maybe you're paying around about 1.5%. Now you're paying 4.5%, 5%. Then it may make sense to pay off your mortgage. But it could also make sense to put money into a pension, because at the age of 50, there's not many more years to go. Now, the other thing that makes it interesting is that, of course, interest rates have gone up and a lot of very fixed rates have come to an end. But the current base rate, 4%, they are expecting later on in the year the base rate to start coming down. So although interest rates from a cash flow point of view on a mortgage might be not attractive at the moment, we don't think they're going to stay at the current level. Yeah, they might go up a little bit more. Maybe the UK base rate might go up to 5.25%. Difficult to tell. But at the same time, we don't think it's going to stay at 5% forever. We don't think it's going to go back to like 0.1%. So I think it will normalize somewhere around about 3.5%. And again, it then comes back to that question of mortgage versus pension. You may have been paying off your mortgage, you might be comfortable within your cash flow. You might be a 40% taxpayer, so pension could be attractive. Some people just like to be able to sleep easy at night, know that you don't owe anyone any money. So it comes down to personal choice, circumstances, the level of risk you're happy to take. Those would be the main factors that would be applicable.
Okay, good. So we've got another couple of questions. So again, please, if you want to ask a question personally to Dipesh Bhai, please raise your hand, use the raise hand feature. So as another question is, do you provide financial advice? I guess that's a pretty straightforward answer.
Yeah, yes, straightforward answer. Yes, we provide financial advice, which covers all areas of financial planning. So today's topic presentation has been on tax year-end planning, because obviously there's a deadline coming up. But in the presentation, I've touched upon things like inheritance tax planning. Yes, we do other things, critical illness, life cover, whatever it is you need, we're able to help you.
Okay, great. Do you provide home meetings?
I do a few. So majority of my meetings I do on Zoom. Zoom tends to be more efficient, but if somebody wants a home visit and they're not too far away, then it's possible to do home visits. But yeah, it's possible.
It's possible, but your preference is more kind of online.
It's preference is online. It's just purely because traveling time can be a lot with traffic and things these days. We have a fairly heavy workload just purely because the tax year end is coming and lots of existing clients need to do things. So yes, it's possible. It might be a case of have a Zoom meeting and then have a face-to-face meeting. Whatever works, we can do it.
Okay, great. Okay, another question here. Would putting your house into a trust for your child help with inheritance tax instead of passing it over in your will?
No, it won't have any impact, because just putting your name, putting your children's name, putting the property into trust and living there is not a good idea, because that would break the gift with reservation of benefits. So if you're going to live there, you will need to pay if your children don't live with you, then you will need to pay a market rate of rent, no family rate, no discounted rate, and your children will need to pay tax on that money. But generally, putting your main residence into trust is not a good idea, because you will also then end up losing your main residence nil rate band allowance, which is, for a couple, is worth £350,000. If you lose that, you'd be ending up paying £140,000. So it's generally more efficient to create a trust within the wills where the surviving spouse can get to live there. But again, you've just got to make sure it's been done correctly. If it's not being done correctly, it's going to cause you a lot of problems. So just review what you've done, check it out. If you want us to have a look at it, we can advise you. But certainly there's a way of doing it, but it's generally you would do it through the will.
Okay, thank you. Is there a way to estimate the capital gains tax on a rental property owned over 20 years?
So there are HMRC formulas. So it'll be based on, so you've owned it for 20 years. If you live there for some time as part of your main residence, then you'll get some relief. So let's say you live there for 10 years, then as a broad, very rough calculation, the gain, 50% of the gain has been wiped out. Obviously, there'll be some other reliefs that you can claim from that point of view, but the gain is going to be calculated as, if you've never lived there, it's the purchase price less it's the today's value. So let's say today's value is 200k. Let's say the purchase price was 100k. Your gain is £100,000, but then there might be some things that you can offset because there might be some expenses. Plus, you got your capital gains tax allowance, which is currently 12,300. You take off your expenses, you take off your allowances, and then whatever's left is then subject to tax at either 28% if you're a high rate taxpayer and 18% if you're a basic rate taxpayer. And if the gain pushes you from a basic rate tax into a high rate, then you could end up paying both 18 and 28% on those various proportions on those amounts that go into the different bracket.
Okay, thank you for that. As a father, if I was to give my son £7,000 and I passed away within 7 years, would he be taxed upon the additional 1,000 above the allowance, assuming the previous year allowance was carried over? And if so, how would the government know that I gifted him 5,000 in the first place? I.e., how do they keep track of the rule of only £3,000 annual gift allowance?
So with that question, if your assets are above the allowance, then there would be inheritance tax. But what you could do is this year, right now, you could use up last year's allowance, you could use up this year's allowance. So that's £6,000. That would be exempt straight away. And you can give another £3,000 from the 6th of April. So you could use up £9,000. This is based on a single person. Obviously, if it's a couple, then it's going to be double that amount. But by doing it that way, there's no need to survive 7 years. You've automatically just used up your allowances in an efficient way. But of course, if your liability is more, you will need to give away more. So anything you give away more than your allowance will be subject to inheritance tax. Now, there are other ways you can do it. You can give away, for example, if you've got surplus income, you can do it that way. How does the revenue know? Well, it's up to you to fill in the forms accurately and honestly. Well, not you, because obviously this will be your estate. It will be the people who are acting on your behalf. So they would have to fill in the HMRC trust form, the HMRC inheritance tax forms, and declare the bank accounts, the amount. So they have to go through the bank accounts for the last 70 years.
Okay. Good. So there was actually an additional piece of that question. How do you give £3,000 of a house as part of the yearly allowance?
How do you gift £3,000 off the house? Yeah, it's not going to be worth it from a transaction point of view, because you'll have conveyancing, you'll have solicitors' fees. £3,000 is not going to, as part of your house, it's not going to make any difference, because if your house is worth just, let's say, £100,000, then next year, assuming growth rate is 3%, it's going to go up by 3,000. So you'd probably be more efficient gifting other assets like cash.
Okay, instead of the house. Okay.
Correct.
Okay, what control do parents, adults have on maturing junior ISAs?
None. Once the child is 16, if it's a cash ISA, it goes into their name. If the child is, if it's a investment ISA, once the child hits the age of 18, it goes into their name. So there's nothing you can do about that. It's there for them.
Okay.
Maybe don't tell them about it.
Right. If I receive dividends above the 2,000, say 5,000, how would I go about paying this tax? Would I have to self-claim this?
Yeah, any extra dividends. So dividends is it's part of you pay income tax on dividends, so you would do that through your self-assessment.
Okay, good. So that was the last of the questions on chat. Has anybody got any questions that they want to ask? Dipesh Bhai, would you mind going off screen, and then we can see if people's got their cameras on and they want to raise a hand, or they want to use their raise hand feature in Zoom to ask any questions. If you want to ask questions, come off mute and just raise your hand if you want to. Or obviously you can still use the chat facility for questions. Okay, anything else to ask anybody? Okay, I think we're done then. If there's no more questions, I can't see anybody's hands up or chat. So Dipesh Bhai, as always, thank you very much for your very informative session. Much appreciated as always. And I guess, thank you for everybody else who attended today and participated. Hopefully you found it informative. And if there's anything that obviously you want to follow up on, Dipesh Bhai's details were on the line just now. You can contact him. So with that, maybe we just wrap it up with a pratna, and then we'll let everybody get on there, enjoy their evening. Kamlesh, would you mind again?
Yeah, thank you, Dipesh Bhai, for another informative talk. That's always very useful just before the tax year end as well. Sorry, my video's going up and down. So we'll just finish off with the pratna. Satyo Maheti Abu Paramase Dayandare Abu Paramase Mahamutyo Mati Ahutasante Nateja Mihunu Shoto Tujadarashana Dhyana Asatyo Maheti Abu Paramase Om Shanti. Thank you everybody for joining. Thank you Dipesh Bhai for hosting. Thank you Dipesh for your talk.
Yeah, thank you. Just everybody. Have a good
Dipesh Bhai.
Thank you.
Okay. Leave this page.